Hello and welcome to episode 237 of the Money to the Masses podcast with your resident expert as always, Damien Fate, and me, Andy Leaks. How are you doing, Damien?
I'm good and it's good to be back on. It's good to do two shows in a row because after we had our break I felt like I missed the podcast, so to have two shows in a row is good. Back to our weekly routine.
Exactly right. So what have you been up to this week? Anything exciting?
Well, it's all about the MTTM, the Money to the Masses event. So,
easy for you to say.
I was going to say, I do the abbreviation, the hashtag. So if you go onto social media and you look at the hashtag MTTM event, then you'll see all the tweets and various different posts on Instagram that we've been doing. So yeah, it's been a lot about that. I mean, the good news is I'm not going to go on about it this week because we did a whole section last week, didn't we? So
and we're a little bit scared that too many people are going to come.
We want as many of you as possible because at the moment, over 300 of you have registered to come to the event, which I'm so excited about. We're all buzzing. We're all going to be there. So if you haven't already registered to come to the event, then make sure you do so. Go to moneytothemasses.com/events to find out more. And that's our event on the 23rd of September between 6:30 and 7:30. Actually, we're going to go on even later. We've been given permission that we can carry on to basically share drinks with you guys. And it's going to be in central London, and it's how to live a champagne lifestyle on a lemonade budget.
And we might even be going to the pub afterwards. In fact, we are.
We are. We're going to we are. We're definitely. We're going to Andy's pub, but we're also going to have
not my pub.
No, not Andy's pub. Another Andy, a podcast listener. So that's fantastic. But on top of that, I have to mention a review we got this week. Now, I asked for you to leave us a review last week. You guys have been listening but not reviewing, so I think you're waiting in the wings for another mug giveaway.
Yeah.
And given that the person at the local post office has been questioning Lauren when she goes down there and feeling sorry for her when she goes with a big supply of mugs to send out. I'm not giving a giveaway on mugs for reviews just yet, but please do give us a review. And one of you did this week, which I'm going to read out. It was truly one of the best out there. Terrific show was the review, and I actually didn't note down the person's iTunes username, but you know who you are.
Yeah.
Actually, get in touch, because if you get in touch and claim it, then I will give you a mug. One mug is not going to break anybody's back, including the postman. So get in touch if that was you.
Good stuff. So what have we got coming up for the rest of this week's pod?
So we got three pieces. This week we got an investment piece again. So I did at first think about giving everybody a break, but I know how popular the investment pieces are on the podcast. I'm going to do a piece that's about trying to forecast investment markets. Now, you know, if you listen to the podcast, how that is a fool's errand if you try and do that. But bear with me. There is some interesting research out there about trying to predict the future of markets, and that includes bond markets as well, that I want to cover, which I think you're going to enjoy. And the other piece is regarding paying off your mortgage, how to pay it off by the time you're retired. And last but no means least, we've had PPI claims. That's dead. That's gone. That was last week. That was the closing date for the PPI claims. But we've got another mis-selling scandal on our hands, and that's payday lending. So if you had payday loans in the past and you've taken out one, you need to listen to this piece.
Good stuff. So what are we starting with this week?
I want to start with an investment piece regarding, it's about macro themes, and it's very different to the idea of reacting to markets. And momentum investing very much is investing based on trends, which it includes a lot of different types of investing. So value investing along the way, small caps investing, because basically what it does, you invest in what's working. And so if a particular style is working, you may not realize it by following a kind of momentum strategy. You do end up investing in certain styles, have biases as they work. And I know 80/20 Investor has that at its core. But what I wanted to talk about is something slightly different. Now, I'm against trying to predict investment markets. It's a fool's errand, as I said earlier, and the reason is you never get it right. If it was that easy to do, you would always predict the future of markets. We'd all be living on desert islands with massive villas, lots of money, and we would be doing the correct thing of buying at the bottom and selling at the top of markets, and it's just not feasible. So there have been lots of people who have tried to come up with different ways of predicting investment markets, and they have generally all failed. Now, if you go back to podcast 207, so episode 207 of this show, we did a piece about the all-weather portfolio. I was asked by a listener to go through the famous all-weather portfolio, which was created by somebody called Ray Dalio, who is a hedge fund manager over in America. And it was a sort of a portfolio that was fairly static, that was meant to make money in all conditions, or as many as possible. Now, go and listen to that show, but I'll just to remind you, the portfolio had about 40% in long-term bonds, it had about 30% in stocks, it had 15% in intermediate-term bonds, it had 7.5% in gold, and it had 7.5% in commodities. Now, I went through and talked about that. In fact, I'd even come up with my own version of that portfolio, a completely separately called the Perfect Portfolio for 80/20 investor members. Much more simple, fewer assets that has managed to make money in nearly all market conditions over, if you look at tax years, so isolated tax years. If you want to find out more, then go and look at 80/20 investor and take out a free trial. But the reason I mention Ray Dalio is because of a investment sort of thesis that he's come up with. So having looked at that 100 years worth of data and the things that move markets, he really came down to the conclusion there are only really two forces that matter, and they are inflation and growth. So we're talking about economic growth. They're really the only two things that he says that matter out there. And it isn't just him. I've seen lots of other models out there that have focused on these two factors. And if you follow midweek markets, you will know that I will talk a lot about inflation. I talk a lot about growth, economic growth, because these two things are important. And there are models I've seen that use these factors in trying to determine the future and what to invest in, that also therefore include monetary policy response. And by that I mean, what do central banks do? What does the Bank of England do? What does the US Federal Reserve do? And if you think about it, they raise interest rates, they produce oodles of money through quantitative easing, trying to control inflation and economic growth. And in those conditions, how they respond to certain conditions, what inflation's doing, what growth is doing, that will determine which assets will be in favour. Now, interestingly, it's not the absolute values you're bothered about in terms of inflation or growth, it's the rate of change. So it's about whether it's accelerating, whether it's slowing. And that starts to lead you into four scenarios. And now I've looked at lots of different types of models around this sort of stuff. And I think it's important to look at lots of different types of investing. There's never one that works all the time. Momentum doesn't work all the time, just as value investing doesn't work all the time. But if you look at something that's a bit different, this is a macro theme thing. It doesn't worry about what Trump's saying. It doesn't worry about what the headlines are. We're looking sort of big picture, what in a given environment, what is likely to do well based on history. So if we look at inflation and economic growth, there are basically four scenarios you can come up with. Now, one of them is that growth is accelerating, so we're getting accelerating economic growth, and inflation is slowing at the same time. The second one is you get growth accelerating, but inflation's also accelerating. Things are really heating up. You get economic growth slowing is the third one, with inflation accelerating, and you can probably guess the last one. You've got growth slowing and you've got inflation slowing. So if you take each of those scenarios, from the first two, central bank policy is fairly neutral. In the last one, it's what they call dovish. So that's when the central banks start to panic and they start cutting interest rates or producing more money through quantitative easing. Now, if you were to sit there and go through each of those four scenarios and had to guess where we are right now, then that would be quite insightful. It's interesting. In reality, we are probably near the fourth one. So the scenario 4, and that's not necessarily a good place to be. And to give you an inkling as to why and how certain assets respond to that setup of slowing economic growth and inflation that is slowing, go back and look at quarter 4 of 2018. Now, any of you who look at your stock charts will sit there and panic and go, hold on a minute, that's when the stock market's crashed, and that's exactly what tends to happen in that scenario. Okay. And so you move from one scenario to the other. So you're never in one for long. It's trying to work out which you are in or which you are about to enter. And to give you another inkling, 2017, when markets only went up, you could have bought anything and you would have made money. I mean, markets didn't even have a 1% pullback in that year from memory. Then that was actually scenario 1, when growth was accelerating and inflation was slowing. Things were good. And so that was very positive for equity markets. So given those scenarios, there are different assets that perform well or badly in different scenarios. Different assets according to the models. And I mean, this is never a given. Okay, this is never 100% accurate, but if you're going to believe the models and look back at history and you can try and ascertain which scenario we are in, based on those, the assets that are in favour you might want to be overweight in, the ones that tend to do badly you want to be underweight. So I will just focus on where we're looking like we have been now for a little while is scenario 4, and in that scenario, bonds do well, okay, because we're in an environment where inflation is starting to slow, so it's deflationary. Economic growth is slowing, so we're starting to end up heading towards recessions. Now, if you follow midweek markets, I've been talking a lot about recessionary indicators. In that environment, REITs, so real estate investment trusts, do well because they're basically a bond proxy. So they're equities, but they focus more on producing reliable income. Utilities in equities, I'm talking about, utilities tend to outperform the broader equity market because, again, they're stable, they're secure types, they're more defensive types of companies. And consumer staples, the things you need to buy, the things that you will always buy whether you're in a recession compared to things that are discretionary spending, the stuff that you'll buy in terms of healthcare products, and you still need to wash your clothes, all these things, they're consumer staples. And finally, healthcare stocks, because we still need medicines. So they tend to outperform. It doesn't mean they won't lose money, but they tend to outperform. And on the flip side, equities generally tend to underperform in that period. And so the model suggests you'd be underweight in that scenario of in equities. That doesn't mean you're not going to be in them. Underweight means you probably might just be slightly more defensive than you would normally be. And the things that tend to do badly are things that are growth focused. So things where it's all about the companies really just scaling. And in particular, that means tech stocks. Tech stocks tend to do very badly in a scenario that I've just described. So to sum up, the models that try and predict the future based upon these two key factors and their rates of change have been quite accurate in the past, in the recent past, of trying to predict the downfalls. The one issue you get is that the central bank response can be disproportionate. So if the central banks suddenly cut interest rates, print loads of money, they can suspend reality. So though the reality of these scenarios I'm talking about are out there, central banks can distort the market so the markets don't actually crash as they would have done in the past.
Because they're trying everything they can to sort of do something about what's happening.
Exactly. They're bailing everything out. And so they're keeping the ship from sinking, even though the mortar's coming on board. And the headlines you see in the newspapers will always focus on Donald Trump, on the latest things to do with Brexit. All these things matter and impact economic growth and inflation, but sometimes not necessarily directly or immediately. And they can be a distraction. So people then talk up about the latest prospects for the trade war. But if you ignore all that, don't look at what's going on in the news. If you just focus on the fundamentals, the realities, the hard data that shows what the economies are doing, what the growth rates are, what inflation is, there are models out there that have been pretty accurate in trying to predict some of these huge sell-offs and rallies. For example, in an environment like we've got now, gold does relatively well. And so it isn't foolproof, but what is useful is some of these things can be used in conjunction with each other. So if you like to favour a particular style of investment, you can use some of these slightly more forward-looking indicators or models to see what type of investment might do well if we're entering that environment. And if we're entering that environment, this sort of area which favours slightly more defensive stocks, then if you're doing something, if you're investing based on value or momentum and you start to favour some of those sectors, you're almost following two methods at once. And incidentally, that's why my 50k portfolio has done so well in August. Those of you who follow midweek markets will see me explain how well it's done and why it was able to make money, because effectively that's what happened. The areas I mentioned that did well or do well in an environment which has got slowing economic growth and slowing inflation are some of the stuff that I hold in my portfolio, particularly, like I said, the REITs, utilities, and even gilts, which obviously have been boosted by Brexit. So the moral of the story is there are different ways to look at things. Don't try and predict the future, but from a very big macro theme, where you're not trying to predict tomorrow's move in the stock market, you're just trying to see where the world's going, then it's a bit like, I suppose, somebody trying to predict the weather for the winter. You know, they get these long-term weather forecasts, and you start deciding whether you're going to do certain things particularly farmers do it, have long-term weather forecasts to see what they should be doing or whatever. It's kind of like that. And I wouldn't base my life or all my investments upon it. But it is interesting that you can focus on the macro stuff and the sort of very few indicators and still have the ability to influence and add context to what's going on in investment markets, and in particular which parts of your portfolio are doing well and why they are doing well.
Good stuff. So it'll be really interesting to see how that all plays out going forward from what you just mentioned.
Yeah, because we're looking at now what I was mentioning about which scenario we're in is like probably in the next sort of quarter. And it'll be interesting to see if these models are correct and we will see more weakness in equity markets, because we are still near all-time highs. So yeah, keep an eye on that. It's something to bear in mind and something to explore if you are interested in the real macro type of investing.
Okay, so we're going to talk about paying off your mortgage and specifically making sure you can get it paid off before you're 65. What have we got on this week's pod?
This one came from some research that was carried out that suggested about 1 in 6 of us won't pay off our mortgage by the time we're 65. That sounds quite a lot, but actually I think that's a realistic and probably an accurate reflection of reality. I think there are a lot of people out there who don't necessarily have a plan of how they're going to pay off their mortgage. Don't forget, we still have a lot of people on interest-only mortgages, which were incredibly popular and available, say, a decade or so ago.
Are you saying they haven't got an investment vehicle or some sort of other way of paying it off? Because I'm sure people were told that they had to have that in place in order to get that mortgage.
Yeah, but you don't. So what happened, people didn't, and therefore they haven't got the means to pay back the mortgage. Because the idea was, if you had an interest-only mortgage, you're supposed to be investing or saving the money to then pay off. So the reason you're paying £200 a month mortgage while someone else is paying £1,000 is because that differential, you should be doing something with it.
But everyone, well, not everyone, but a lot of people are sitting there pretty thinking, I'm saving money, and actually there's equity building up in the it's tomorrow's problem.
Yeah. But of course it will be tomorrow's problem. Tomorrow always comes. That's the thing. And I'm personally quite happy about the fact that interest-only mortgages aren't as prevalent as they used to be for people taking them out now. Because when I bought my house, I deliberately had a repayment mortgage, even though they were available at the time. And that was because I did want to be able to protect myself against negative equity, because I was always paying off the mortgage and I'd have the ability to move. It allowed that flexibility. And so ensuring a flexibility in your finances is almost the one thing I always try and do. Is if I can make a decision that makes it more flexible, then it's worth doing it, even if financially in that scenario I was paying more than I could have done if I'd had an interest-only mortgage. So I think it's good that people now are on the whole moving towards repayment mortgages, because it means they're not going to be left, or less of them are going to be left struggling when they get to 65. So what can you do if you aren't going to pay your mortgage off, or you don't think you will do? Well, the first thing is overpay. You need to contact your lender and ask about the rules surrounding you overpaying them, and how much you can overpay without incurring penalties. And if you overpay your mortgage, and if you can afford to, then you will be able to reduce the term of that mortgage and pay it off sooner. Alternatively, one simple way, if you've been living in a house for a long period of time and you haven't remortgaged, you could probably remortgage onto a better rate, a better deal, which will enable you to repay more quickly. You could have a shorter term, but you may find that you can get a better rate now, and therefore you could be overpaying where currently you're not able to, without paying actually any more money a month. So go and speak to a mortgage.
That's just making a phone call, essentially, and you could be reducing years off your mortgage.
Yeah, but importantly, you should also go and speak to a mortgage advisor. There's plenty of them out there. There are online brokers. You should go and speak to them, because there's plenty of different products in the market, and they'll be able to look at them all. And if you go to an independent mortgage broker, they're not tied. They won't only recommend their own products. If you just speak to your current lender, they'll only offer you something from their existing menu of products. So go and speak to a mortgage broker about your options.
Yeah, and actually we've done a review of, there are lots of independent mortgage brokers out there. You can Google them, of course, but one particularly that sticks in my mind, something we talked about recently and we wrote a review, is a company called Habito. They're an independent. They're one of these tech firms. They've really got the tech. They understand what they're doing, and you can do your remortgage online. You can speak to real human beings. They're pretty smart at what they do. Go and check out the review on the website. I'll pop the link on the details.
And actually, if you've listened to the show last week, you'll know that we've actually got somebody from them on the panel. We went and deliberately asked them to be on the panel because
that's at our live event.
Yeah, that's at our live event. That's how good they are. Now, of course, you do have the option of continuing your mortgage. So you may have a generous pension when you come to retire, so you get to 65. So make sure you work out what your pension is worth. You can do that via the calculator on our website if you want. So if you go to our website and search for pension calculator, you'll find it. Or alternatively, you can search for how much do I need to retire on our website. We've got a whole article which we updated this week, which talks about how much you will have when you retire. So you need to work out, can you afford to still be paying your mortgage if you're going to have to? The other thing is considering if you can take a tax-free cash out of your pension to pay off your mortgage. Now, that isn't always necessarily a good idea because you're going to need the pension to conceivably keep you in retirement. So a retirement income, you've got to generate one, and you're more likely to run out of money if you take a big lump sum out to pay off a mortgage, for example. So again, go and speak to a financial advisor in this instance, and they'll be able to help you. So the alternative, which no one really talks about, is carry on working. Now, that's not going to be popular. For some people, that is going to be what they have to do. But when I say carry on working, I'm talking more about coming up with something that will generate an income that may not be your full-time job. So Money to the Masses is a perfect example of something that started as a side hustle. I don't like the word side hustle, but something that was on the side that I was doing that then became the sort of monster that it is today, that you may be able to monetize in time a hobby that you have. So you may have something you enjoy doing, you may have a hobby, it may just be something you're interested in, and you may start writing a blog, growing a presence online, and then you'll be able to in time make a small income from that, or even a big income. But the tip is start doing it now, because Money to Masses has been around now for over 9 years. 9 years ago it didn't exist, and so we got this far through lots of hard work over the years, but at the beginning it was just a humble blog. So you can do it. I'm talking about it from experience. This isn't somebody just coming up with some crazy idea or whim that is possible. Yeah. We're doing it. Me and Andy are sitting here. Andy,
I was going to say, even I've got an example. I worked in finance. I worked as an accountant. On the side, I was writing books and earning a steady income. And it can be done.
Andy's being modest. He was a bestseller. You got to number one on Amazon. Let's not belittle it. You're on telly about your books. He will always try and be modest. So if you want to ever find out that story, go and listen to our podcast series, One Giant Leap. I actually interviewed Andy as one of the shows. But yeah, that's a perfect example. You can do it if you follow a passion, and there's nothing wrong with that.
And even editing this podcast, I was doing that in my spare time on top of doing my day job.
And now you work here.
Until he realised the talents needed to be a full-time employment.
Exactly. So do think about it. Just start following something you enjoy. Don't worry about what everybody else thinks. Don't worry about your friends and that think you're crackers because you're putting stuff online and they're going to be critical of it. It's your life. Go and lead it. The other thing to do in retirement, consider using savings if you have enough to start to reduce your mortgage. Now, of course, that does depend very much on the interest rate you're paying on your mortgage and whether the rate of savings, it balances out. If you've got a very low mortgage rate, but you can get a decent savings rate, then it doesn't necessarily make sense to pay them off. Of course, downsizing is one of the options, but I do think that a lot of people don't necessarily want to have to downsize. I know people who've been forced to downsize, and they've sat there in the house making out that they're quite happy about this prospect, yet they've gone back to live in places where they'd felt they'd actually moved on from many years ago when they were younger. So I'm not sure downsizing is for everybody. But the other ones are, of course, you could look at retirement interest-only mortgages. Go on our website and Google that. You'll find out more. And, of course, equity release. I'm not going to dwell on it now because I'm conscious of the time on the podcast. But you can use equity release as well to try and pay off some of your mortgage. But both of those do seek advice, because as much as they can solve a problem, they can create another one. For example, equity release, the interest on the loan rolls up at quite a rate, and therefore you can find that after you've died, the loan is actually quite sizable. So search on moneytothemessage.com for more info, but I just want people to make people aware that they exist. So the point of this piece is that if you're young, then one of your biggest options and best options, if you want to make sure that you are going to pay off your mortgage, is to overpay, remortgage, plan ahead. If you're older and you're getting near that point, then you're going to have to look at some of the other options I said, which is alternative income, downsizing, using savings, pensions, those sorts of things. So it's about planning. Don't bury your head in the sand is the message.
Okay, moving on to the last piece of the podcast, we're going to be talking about payday loans, and it is the new PPI mis-selling thing. It's on the tip of everyone's lips because PPI's gone, the deadline's gone. We need a new thing for people to be talking about and getting excited about, and
we need something else for the ambulance chasers to chase, which is, I mean, it'll be people listening to this podcast, and I know they'll get frustrated and say, "Oh, for goodness sake, we've got another thing that's come along," and people are just trying to chance their arm at claiming money. But there is a very real mis-selling that's gone on out there. And I only mention it because now we've got people's focus on the idea of PPI and mis-selling occurs. While you've got that focus, you might as well ask them or tell them about the PPI mis-selling scandal. They're already in the mode. They've already got them excited about the potential. Why not tell them about another one? Because some of the people who had PPI and didn't realise are probably some of the people who've taken out payday loans and didn't realise that they were mis-sold. So I'm going to rattle through this list. Okay, because it's just something that I want people to have an FYI and they can find out more info. So you could potentially have a payday loan claim if you've been mis-sold, because there are a number of criteria that you have to look at. So if you couldn't repay the payday loan, you had no means really of doing that, and the lender didn't check your financial circumstances, then you could have a claim against that payday lending company. Or if they kept reselling that idea of a payday loan to you. So people got stuck in a spiral because the interest rates were so high. So they'd get on this almost hamster wheel of debt, and they only originally borrowed, say, a few £100, and then years later they're thousands of pounds in the red because of the way payday loans escalate and the ease at which they were able to keep getting these loans. So that was actually ruled to be unethical. Yeah. So if any of the following, and I'm going to read them out, apply to you when you took out a payday loan, there are other criteria, but here are some of the main ones. If any of them feel like they apply to you, then the first thing you need to do is jump onto Martin Lewis's Money Saving Expert, because he's got whole templates about this stuff. Debt Camel is another good website that covers a lot of this stuff. Sarah, I know her personally, she runs that site, is very good. So there's a whole load of stuff on there about how you can reclaim against payday lending companies. The thing is to also point out is that obviously these ambulance chasers, the companies that will claim for you, are wanting the next gravy train, and therefore they are taking about half of the money from the people whose claims they process. You don't need to do it. You can do it for free. So make sure you go on and have a look. Now, if any of this...
I would argue as well, for payday loans, it's easier for people to claim on it, because the PPI thing, there were so many different loans and credit cards, and payday loans, you'll know if you had one, and generally people tended to stick with the same company once they knew they could get a payday loan and they were attached to it. So you'll know in your head who that lender is, and they're the guys you have to go after.
Yeah, exactly. And Wonga is one of them. Remind me to mention something about Wonga in a minute. But on this list, if you shouldn't have had been lent to, as you couldn't actually afford to repay the loan, for example, there are people who may have had income of a couple of £100 a month, but were given a payday loan of an equivalent amount or more, and they really shouldn't have been lent the money. If the lender didn't give you some examples of the cost of, say, what £100 payday loan would ultimately cost you, that's another potential reason to claim. If you weren't given full info how and when you were to pay it back, if they didn't check your finances, if they didn't explain to you that it was a short-term financing opportunity, not a long-term solution to finance, how late payments would impact you, so there were no warnings about late payments, or how continuous payment authorities work, so the mechanism by which they could keep taking money from your debit card or credit card to repay the loans. If they didn't explain how that worked and your rights to cancel it, that's another reason. If it got to the point where you were struggling with the debt, if they were unsympathetic in any way, if they didn't refer you to free debt help or counselling services that are external, there's plenty of them out there, or they didn't even freeze the interest or charges, then these are all reasons why you could have a potential claim. So if that is you, then do go and check out those two websites I mentioned and explain what you need to do to make a complaint against your payday lender. And the one thing I will mention is Wonga was obviously one of the biggest out there, and it's slightly different because it went bust, and there are slightly different rules. So if it's Wonga again, those websites do explain what you will have to do to try and get something, if anything, back from Wonga.
Good stuff. So that's us done for this week. So please do, as Damien said earlier in the podcast, review the podcast. It really helps us go up in the rankings and helps us spread the word and help more people. Plus it makes us feel good as well. And If you do so, your comment might just make its way onto our wall of love. And how about that? An inspirational message that you send on your review may well end up on Money to the Masses Wall of Love.
And to explain to those people who don't know what the Wall of Love is, the Wall of Love is a wall in the Money to Masses office that is turned into by use of a massive decal sticker, where we get the designer to put your quotes and what you say about us into a big design on the wall, and it's inspiring to us. It's very motivating, and it also looks amazing. So keep an eye out for that on social media in the coming weeks, but you may get on it if you leave a review.
And in fact, we are recording this episode on video as well. And there's a blank wall behind us at the moment. And people who are watching this can see that there's a blank wall. But if you do review the podcast and you do watch future episodes that we do video, you may even see your comment behind us. So how about that for inspiration? Make sure you review us. Do contact Damien if you've got any questions on the podcast. It's Damien at moneytothemasses.com. Twitter, it's at Money to the Masses with a number 2. You can get us on Instagram and Facebook, all the usual places, but please also head over to YouTube. We're doing lots on our YouTube channel. Subscribe, share, and speak to your friends about that.
And like it.
Yeah.
To try and push those videos.
Oh, and press that little bell. There's a bell notification. It'll tell you when we upload videos as well.
Perfect. So that is it.
Yeah, we're done. Sorry. Until next time.
Until next time.
Bye.